Mansa X delivered a return of 3.8% in the first quarter of 2022. This is an annualized return of about 15.2%. This compares with a return of 4.19 in the first quarter of last year. So this was a very exciting quarter. Just looking at the carryover of inflationary pressures from last year, supply chain constraint led inflation. This continued into the first quarter of this year, and we expect that this will continue to be the case. And this created a lot of concerns around how the central bank would change their stance around interest rates. We also saw a lot of geopolitical tensions rising in the first quarter of this year. And from a fund manager perspective, this required a lot of recalibration of the fund in order to optimize the returns for our investors by taking advantage of all these moving parts while still really protecting the investors' funds from the downside risks created by these events. For the first quarter of 2022, we had a very interesting scenario where the factors that created inflationary pressures, the factors that created geopolitical tensions, caused some of the asset prices to go up in certain sectors, so commodities especially. So we saw commodity prices rising, and the fund was able to take advantage of these rising prices. If you look, for example, at WTI crude oil, it jumped from $75 a barrel to as high as $130 a barrel. We were obviously invested in that. We were very heavy in long positions. We got into wheat positions. We got into corn trades. We got into soybean trades. We are constantly holding gold positions as well, as we've always mentioned to our investors. Just looking at wheat alone, that jumped over 30% in the first quarter of this year. Soybean prices were up 26%. Gold prices up almost 6%. And all this led to a very good return for the fund in those long positions in commodities. Another interesting aspect, and this was a very unique trade for us in the first quarter of this year, was actually investing in the volatility index. This means that you can actually buy into the fact that there will be volatility in markets. And this is called the VIX. And we were invested in the VIX, and this rose by almost 20% again in the first quarter. As I had explained at the end of last year, we still felt that a lot of technology stocks will come under pressure if inflationary pressures continued, and we saw this happen in this year. Based on this, we then got into some short positions. The first biggest short position we got into was in Adidas. So we expected that Adidas would lose value because as inflationary pressures increase, consumer spending is expected to reduce, especially in non-essential goods. So companies like Adidas and Hugo Boss and Louis Vuitton would typically take a hit, and we went short some of those stocks. But very interestingly, it was our most interesting short positions were actually in technology stocks. So we were very short stocks like Roku. Roku dropped about 45% in the last quarter alone. We were short PayPal, dropped almost 40% as well. We were short DocuSign, which dropped about 30% as well. We were short Netflix. Now, Netflix is actually one of our most interesting plays in the first quarter of this year because we were short Netflix, which dropped about 37% this quarter. We are still holding a short in it. Just yesterday alone, it dropped another 35%. And this again shows you how interesting it can be to make money when stocks are actually losing value like this. We were also short stocks like Square, now called Block, which dropped about 36% as well in the first quarter. Some of our long positions as well took a hit in some of our tech stocks because we have tech stocks that we like. We still like stocks like NVIDIA, we still like Microsoft, we still like Alphabet. But it will please our investors to see. You have seen the percentages that I'm quoting for the other stocks and how much they fell by, typically an average of 35 to 40%. But if you look at stocks like Nvidia, yes, they fell, but by about 7% only. Microsoft by about 8%. Alphabet by not more than 4%. So yes, we lost some value in those stocks, but not as much as in the ones that we went short in. Now again, this again proves a model of the fund that typically we will be able to take advantage of falling prices in some stocks, and this will protect us from the falling prices of the stocks that we like. So one of the reasons we'll go short a stock is we feel that there's a lot of overvaluation in that stock, and if we feel that that particular stock does not pay dividends, telling us that this stock can only gain in value if there's a lot of liquidity in markets. If central bank policy stances are changing and they might start increasing interest rates, then the liquidity drops. And based on this, we then believe those stocks will lose value tremendously. So we will take short positions in those ones. The war in Ukraine was definitely one of the biggest events that affected our return in the first quarter of 2022, and not necessarily in a bad way. What events like this do is that they create volatility in so many asset prices, and there are ways that you can take advantage of this. The most obvious one, and I've mentioned this before, was the rise in commodity prices. So you had a rise in oil prices, wheat prices, corn prices, sugar prices, soybean prices across the board. And we were able to take advantage of these prices by buying these asset classes at a lower price and selling them at a high price. On top of that, we saw a rise in the share price of a lot of defense stocks. So companies like General Dynamics and Lockheed Martin. The stock for General Dynamics went up by 15% in the last quarter. Lockheed Martin gained by about 24% during the same period. Now, the reason for this is because governments around the world increase their defense spending whenever there's geopolitical tensions, especially the governments in Europe. And this helps to push up the prices of defense stocks. Inflationary pressures created by this kind of war again causes yields to go up around the world as central banks try to increase interest rates to reduce inflationary fears. If you look at the inflation rates in the US right now, the inflation rates are at 8.5%, the highest we have seen in over 40 years. So the amount of pressure the Federal Reserve has to increase interest rates is quite significant. So we saw the German bonds, for example, we saw the interest rates go from negative 0.17 at the beginning of the quarter to close at 0.55, positive 0.55 at the end of the quarter. That's a 400% increase in interest rates. That's quite significant. The US Treasuries, we saw them go from 1.5% to close at 2.3%. And as we speak, the US Treasuries are now trading at 2.9%. They've essentially doubled in value from January to now. And we expect that this will continue to increase. We expect that interest rates, for example, for the US 10-year Treasuries, we expect them to hover at around 3.5% in the next quarter. Again, this is all because of the US. This is, again, because of the Ukraine invasion. And the fund was then able to make a return by taking advantage of these yield prices. Typically, what this means is the higher the yield price is, the lower the bond prices. So you can actually go short bonds in the US and in Germany and actually make your return from that. Again, inflationary pressures created by the Ukraine war created inflationary pressures again that pushed down a lot of tech stocks and a lot of European companies that are dependent on commodity pricing. So again, that's the reason why we were very short some European companies like Adidas, Puma, Louis Vuitton, because of the inflationary-led pressures that would then affect consumer spending. So if consumer spending is affected, the first companies to be affected are companies that sell non-essential goods. So just to summarize that, the war in Ukraine right now creates a lot of volatility and creates a lot of changes in the pricing of a lot of asset classes. And all these are things that a fund manager who runs a multi-asset strategy, long-short strategy fund like ours can actually take advantage of. And Mansa X was well placed to take advantage of all those scenarios. Q2 of 2022 is expected to be a continuation of Q1 in terms of a lot of what happened in Q1 and the effects of what happened in Q1 spilling over into Q2. So we'll be watching a few key things. The first one will be we'll be watching the earnings of companies. It will be very interesting to see whether companies are able to pass on the increased costs of production to their consumers, and if they are not, the effect of this on their bottom line. It will also be interesting to really watch consumer spending numbers. Consumers going to be able to keep up with the rising prices? Is consumer spending going to reduce, or is it going to keep up with higher costs? We expect that it will probably struggle to keep up. The other thing would really to be watching central banks around the world, starting with the US, with inflation at an all-time high at 8.5%. It will be interesting to see whether we'll see more rate hikes. We saw a rate hike in March of 25 basis points, and we are now hearing a lot of Federal Reserve presidents calling for an even higher rate hike of above 50 basis points, probably even next month. So it will be interesting to see how this affects interest rates around the world. And this is not just in the US. If you look at the ECB, they're already calling for 4 rate hikes just this year alone. And this is around the world, from Canada to Britain, and it will be interesting to see how this will affect yields around the world. Commodity prices, we'll continue watching very closely whether commodity prices will continue to be on the up. We think they will. Just looking at oil alone, WTI is still trading above $100 a barrel at $103 a barrel this morning. We expect this to continue to rise. Gold prices will expect to continue rising, and we continue to hold gold as a hedge, especially in our cash book. So we expect that this again will continue to rise in value. Soft commodities will probably be one of the biggest headaches for governments around the world, especially those governments that subsidize food prices. So looking at the price of wheat will be an important commodity to watch, followed by corn, soybean, and sugar. We expect that because there doesn't seem to be a sign that the Ukraine invasion and war is going to slow down anytime soon, we expect that these prices will continue to rise. So the fund will be seeing how to take advantage of this rise in prices, whether it's buying directly into these assets or buying into companies that benefit from the rise of these asset prices. So you expect that Q2 should be an even more interesting quarter for trading, because we do not have the burden of having to recalibrate. We now just have to focus on really just taking advantage of opportunities that had already been identified in Q1. And therefore, we are very optimistic about performance in Q2. I'd like to thank our investors for believing in us, for investing in the fund. Well, first of all, the fund has grown. Within that quarter, we grew the fund by about 1.3 billion shillings. And a lot of that growth was also because of current investors who continue to top up and increase their investments within the fund. And we've also seen a lot of new investors coming in. So I'd like to thank everyone for continuing to believe in us, continuing to believe in our model. And I would like to affirm and give confidence to investors that the way we have modeled this fund is such that it can weather a lot of storms. We have gone through the COVID times in 2020. That was an erratic period, and we were still able to deliver a return. 2021 was relatively smooth, but there are still fears of Omicron around some point in 2021, and we were still able to weather that storm. And now this year, again, we're dealing with very serious concerns around geopolitical tensions and inflationary concerns. All these are things that the fund is designed to deal with, and in fact, sometimes can actually optimize the returns from. So we want to continue giving our investors confidence that we'll continue to optimize returns for them, continue to be very careful about downside risks. So this is not something that they should worry about. On every Kenyan's mind as well right now is forthcoming elections. Everybody is concerned about, will these elections affect the returns of Mansa X? So I'd like to give investors confidence that Mansa X is designed to make a return irrespective of what is happening in any one market. And elections affect the Kenyan market, or rather affect local scenarios, but our exposure is to very many other economies and asset classes. So we don't expect that there should be any difference in how the fund performs. So moving into Q2, We expect, as I mentioned earlier, that it should be a lot more interesting in terms of having aligned the portfolio in the direction that the globe is now taking. And we expect that Q2 should be a much better quarter for investors. Thank you very much.